Hello and welcome to the M&A Science Podcast. This podcast is part of a mission to rethink how M&A is done. The old school seller-led approach, it's dead. Buyer-led M&A is all about strategy, alignment, and efficiency, putting value creation at the center of every deal. And let's be real, it's not just about closing the deal, it's about making it successful. We uncover what truly works in M&A by learning directly from the best. I'm your host, Kisan Patel, founder and CEO of Deal Room and chief scientist here at M&A Science. Today, I'm joined by Javier Enrile, managing director of M&A at TIAA. TIAA is a major financial services organization focused on retirement, asset management, and insurance. Manages over $1 trillion in assets. Javier spent his career deep in the world of M&A, starting out in corporate and investment banking at Citi before moving to the buy side, where he's led deals across investment management, insurance, and financial services. He's one of those rare M&A leaders who's as passionate about the craft as he is about execution. Today, we're going to get into how he approaches sourcing in a relationship-first industry, how he thinks about intrinsic valuation versus comps, and why structuring and contract terms matter just as much as price. Javier, how you doing?
Good. How are you?
Hey, thanks for joining me live here in Manhattan at our sponsored office suite by VRC, Valuation Research Corporation, and we're doing this live. Thank you for making it happen, taking time.
No, of course. Thank you for having me. I'm super excited to be here with you.
Can we kick off a little bit about your background?
Yeah, for sure. I started my career post MBA at Citi. So I was sort of recruited into Citi in their investment and corporate banking role, and started doing M&A advisory and corporate lending there. Quickly realized that I wanted to be more on the buy side of things rather than the sell side. And so I switched into corporate development roles for different firms. And I've done corporate M&A, private equity, venture capital as well throughout my career, but primarily focused on the financial services industry.
How many deals you've done?
Over 60 or so. And if you count kind of the ones that we evaluated, so hundreds.
Okay,
so quite a few.
So let's say the 60, what was the range? Smallest to largest deal?
Yeah, no. So look, I've done anything from $1 billion check sizes to a few $100,000. And I think most practitioners will tell you that it doesn't really matter at the end of the day. So size. So M&A is one place where size doesn't matter. So you'll do the same amount of work for a $200,000 deal than you'll do for $1 billion. In many ways, smaller deals, as everyone knows, are actually harder to do because then everything matters.
That's true. That's a fair disclaimer there, because there's what looks good on a resume versus the work you end up learning lessons from. You've done the investment side, and then you shift over to the buy side.
Yeah.
You know, what's how do you explain to somebody? Because I feel like there's so many people I interact with that are in banking. They want to go to private equity, and then a lot of people aren't familiar with corp dev. If you talk to anybody in business school, they're just like aren't exposed to it. Give me the real scoop. Like what's good and bad about being on the buy side here, especially in the strategic environment.
Right. No, I think of corporate development, corporate M&A, so doing M&A within a firm. In many ways, the combination of private equity with strategic thinking. So you have components of both. Right. On the one hand, you have the component of you are in the buy side, meaning when you analyze a firm or buy a firm, right? You are taking the principle, right? You are taking on the risk, right, of taking on that firm into the firm that you're working for. So taking on that target into the firm that you're working for, and in many ways, then you're a principal, right, driving that decision, which is different from, say, you're an advisor, right, in investment banking, where you're essentially advising someone else what to do. But the decision is theirs. In here, you are essentially making the decision as to whether or not to buy, etc. And then you combine that with the strategic component, right? Like as we underwrite transactions, we underwrite them for the financial return. So it has to make sense from a financial perspective. but we also underwrite them for the strategic rationale. So we want to make sure that it is advancing the strategy of the firm that I work for. And those two things essentially need to be true for the transaction to move forward. And that's one of the things that I like the most, right? It's not just about underwriting financials, right? Underwriting the financial merits of a transaction, but it's also just as much in a corporate M&A role, underwriting whether it makes sense strategically for the firm. So I think that's different, right? So if you're in a private equity world, right, that you're really underwriting the returns, which is difficult enough as it is, right? But it's just that one-dimensional component of it.
You're clicking into more details because there's this how this is actually going to come together, how you're going to realize synergies, and what it's going to look like as a real combined entity. And I don't want to. We have a lot of private equity people listening to this, so I'm watching my words here. I feel like the ideas are there, but right. I guess the sort of depth, because you're not in the business of how you're actually going to execute and realize those synergies, maybe isn't as detailed or well thought out.
Yeah, I mean, I think it depends what sort of private equity investing style you're thinking of, right? I think if it's more of a buyout, private equity buyout, right, which is essentially you're coming in as a private equity owner, you're taking control of the firm, and you're taking it in a different direction, right? I think there then you will have to kind of think through very deeply, right, as to what is the strategy of the target, right? Because you're essentially changing everything, right? You're coming in, buying it, and taking it into a different direction, right? But it is true, right, that you're always, from a private equity perspective, you're always thinking about the target, right? In the context of a corporate M&A team, you're thinking about the target, so it has to make sense, right? Synergies have to be there. But you're also thinking about what impact that target will have into your firm, which is something the private equity doesn't have to worry about, right? Like they're not integrating anything into the private equity firm, right? It's just an investment.
Yeah.
That opens a whole, I agree with you, it opens a whole dimension, right, of issues, of factors that you need to think through.
I just talked to a person off record, and he was telling me PE firm supported acquisition for the company, and they really left him to figure out how to close or how to integrate. Like as soon as they close, it's like, all right, here you go figure out how to integrate it. And but it was just a deal that happened so quick. But there's
Right. And I think that's...
but they move fast, that's...
Right, that's the problem. I mean, I think that, that is one, unfortunately, right, and the market is the market, right? So you'll have situations where it's a competitive bidding process, right? And then the timing is not marked, or kind of like the tempo, right, is not led by you, right, as a buyer, but it's led by investment banking that is running a sale process. Right? Then sometimes those, as you well know, right, those timelines are very compressed. You don't have time to think about integration, or you're just trying to win the deal and the integration comes later, which is really unfortunate.
Yeah, you minimize it. You literally pull steps out and just do the bare minimum.
Right.
I've never met a buyer that really enjoys auction processes.
No one does.
Nobody does. If there's anybody listening that's a buyer that loves auction processes, let me know.
Right, no, they should let me know too.
I'll interview you.
That, with all my heart, yeah. And look, I don't think, obviously, I'm sure that you have some sell-side bankers listening to these, right? So I don't think they generally work, right, for industries such as the industry that I play, my sandbox, right, which is investment management or financial services. I think if you from a sell side, if you run a sell process, it's going to typically lead to a bit more deterioration of the business by the time you get there. Obviously, the counter to that is, well, you're going to maximize price, right, because you have competitive tension and all that thing. I don't quite agree with that. I think, not because I'm trying to avoid sell processes, but I do truly believe that in industries where the main asset is people and investment management and financial services for the most part are those industries, I don't think that sort of running a quick, highly competitive sell process is going to help anyone. I think it's just not going to help the target, it's going to help the buyers. But unfortunately, they still exist. So we have to live with them.
We can talk a lot about that. There's the good and bad of those processes, but this is why you put a lot of effort in building Proprietary Pipeline.
Right.
What is a big thing I want to talk about? Before you build pipeline, you got to get aligned on strategy.
Right.
We obviously emphasize that. So you obviously have different business leaders in your organization, and you're going to sit down with those business leaders and really start talking or shaping it. What does that process look like? Because I feel like there's sort of an organic view to inorganic, right. And do you sort of bridge it based off of the organic view? Like how do you sit down and start fleshing out this M&A strategy for that business?
Right. Look, I think that there's three steps primarily, right? I think the first step is fully understanding their organic strategy first, right? And so the process starts there. Typically, most of the businesses, my current firm and other firms that I work with, they do have a clearly laid out organic strategy. So they know where they want to be in the next 3 to 5 years, and they know how, sort of the steps, right, the tactics, right, that they need to get there. But that's sort of the base, right? In most cases, they'll come to us, to me, to the team, right, saying, well, this is my strategy, it, right, my organic strategy. What can we do to accelerate the progress, right, through inorganic means? I think then that starts that conversation, right? And it could be, hey, I want to be more prevalent in this jurisdiction. I'm already opening some offices already there, but I want to accelerate that process. Is there an option here to then go and buy a company that then will accelerate that process, right? So I think that's the second step, right? So a lot of the times it's around getting there faster rather than doing something else different. But that tends to be kind of like the second phase of the conversation. Then the third phase then becomes more.
Well, is the second phase like actually identifying companies, or
no? That's their phase, right? So okay. I think once look. So in this example, for example, it's like, okay, now we realize that we need to buy a company next year.
So just saying, okay, first step is to understand the organic strategy of like how you're currently planning to do it, and the second is saying, can you actually do it inorganically?
Right, and how inorganically will help you to either essentially accelerate that pace of progress, right? Yep. And then the third step, right, is okay. So no, we know we need to buy something in this jurisdiction, right? What are the types of targets, right, that we would be ideal, right? And then that is kind of like the third phase. And then if you go through these three steps, right, you'll end up with a clear picture, right, of first of all what it is that company will do or will help you do, to what types of companies and in where you want to buy them. And then if you think about it from a corporate development guy, corporate M&A perspective, that's perfect, right? Because then you have essentially the key strategic criteria, and then you just then have to go out to the market and look for those types of firms, right? But you have a clear set of criteria that kind of like informs your sourcing routines. But those are the three phases. I think there's another phase right within that process, which I've gone a number of times, right, which is kind of the analysis of whether you buy it or you built it, if you will, right? And these are in areas where there's no current inorganic efforts, right? This is a total new area, right, that you want to get into as a company. And then sometimes we get into, well, should you go organic or should you go inorganic, right? So I think that analysis goes on at times. But I think most often than not, there's an organic strategy already set up, and then you're using M&A as a way to turbocharge, right, to accelerate that strategy.
Step one, understand the organic strategy. Step two, really figure out how an inorganic approach can work.
Right.
Step three is find those types of targets that you can and really like ultimately your deliverable is the clear criteria of those businesses that would fit in to accelerate.
Because then it's easier, right? Then you go out to the market, right, with a very kind of narrow criteria. Because one thing that I think it is not helpful, right, is when you as a corporate M&A guy or private equity guy, right, you just don't know what it is that you're looking for, right? So the more narrow criteria that you have, that you work with the business to design, then the more efficient you're going to be as you go out to the market and start searching for firms. I think the last thing that you do, right, is thinking about what are the key characteristics of the firm, right? But this is getting even into more detail, right? So, for example, right, do you want a firm that has this certain amount of EBITDA, right? Do you want profitable firms versus not? What type of characteristics do you specifically want on the firm that you're looking for? And I think those will come a little bit later.
Yes. I think you'll learn that too as you start looking at companies.
That is true.
Have you found this right size of a target list? Because I feel like it's easy if you don't do this that you're going to end up way too many things to look at. So you want to get that down. But then I don't know if there's such thing as too short of a list, because obviously, right, like people don't instantly want to sell. This is a relationship that you have to nurture. So is there an ideal amount that you feel like, hey, I want whatever, 80, 100 companies that I should have in my pipeline?
Yeah, so we much less than that, right? So I mean, I think we've run sort of like searches like this, right? So because essentially the way we work, right, is that we've got an ecosystem of market participants, and then we on a constant basis we are informing them of what we're looking for, and then the deals then will come through that ecosystem. And so far, it's been a very sort of fruitful and very efficient way of getting a pipeline that is quite active. So we've got enough coming to us, right, that we feel comfortable. Now, I think the key there, right, is to make sure that the market participants that you have relationships with, and these are intermediaries, these are other corporate development teams, right, other companies in the industry, that they know what you're looking for, right, and then they know you, right, so you've built those relationships. And then if they hear of a company or they hear of a potential situation, then they'll come to you, right? So I think that's very important. Now, there'll be other situations, right, where we've essentially gone from the scratch. We are looking for a certain type of company. We look out to the databases, right, on market. We kind of go through all the list of firms that have a certain criteria. And I think the idea there is kind of like a filtering exercise, right? You want to get to 10 firms or so that really you think that, at least on paper, meet the criteria, and then you start calling and building, and then there'll be, out of the 10, 6, 7 will say, well, don't talk to me because I don't want to sell. There'll be 4 that you say, maybe, right? And then you start building that relationship with them.
How do you approach sourcing targets in a buyer-led way that builds trust and maintains momentum?
Right. Look, I think it's so that the approach has to be a soft one, right? So it can be that you can like call them up and say, hey, by the way, I want to buy your firm, right? That wouldn't work, right? So I think it's more around, you start the process with just wanting to learn about the firm, right? So we typically engage with these firms more in the context of, look, we want to learn about what you do. We want to learn about the industry. Can you talk to us about what you do, the way you do it, the challenges, right? So it's more around understanding how they do their business and the successes and threats, rather than, hey, I want to buy you, right? And then you build that relationship over time.
But you're trying to get to CEO or the main principal,
right? I mean,
operator.
I think at that. So depending on the size of the firm, right? Like we're middle market primarily, right? So then most of the firms will be talking with the founders of the firms. If you're thinking more larger firms, right, you're at the corp dev level, CEO level, strategy level, right? Depends on the size, right? But you're getting to that kind of like level.
And so I get the whole, hey, I'm not trying to close it right away. I want to buy you guys. But would they respond to that of, I just want to get to know what you do, or they already got a sense of like, all right, I kind of know where this conversation's going?
Most people, I think they'll be open to dialogue, right? I think, I mean, they see this M&A guy calling them, right? So they suspect that there is a corporate transaction going on here. But they'll be curious, right? They'll take the call. It's building a relationship with another firm in any case. So even if there isn't a transaction, they have essentially entry point into a firm within their own industry, right? So I think most people do take the call. Because at the very least, right? Again, they've developed a relationship with another firm. They can exchange some ideas, right? Compare notes and learn something new.
I like this. We're talking M&A pickup lines. So that's what I do. I'm like, hey, we're in adjacent industries. Love to connect and compare notes.
Right.
I'll either do that or, I got some ideas. Hey, love to compare notes. Got some ideas that I'd love to share with you. And I keep it super ambiguous because it's like, you got to talk to me if you want to see what those ideas are. That's what I found works. I don't know, but it's really similar, very similar.
Right. I mean, I think another M&A pickup line using your your lingo, right? Which I like, right, is when you inquire about their growth strategy, right? So they tell you how they plan to grow. We tell them how we plan to grow, and 90% of the times, right, then you can see that there is either there's a gap, that there is a commonality, or there isn't, right? The typical example, right, is like I'm talking to a firm and they say, I want to grow big in Japan. And I say, well, I'm huge in Japan, but I want to grow where you are. There you go. So now
that's actually, I actually like that perspective of, it's not only comparing notes, but let's like compare growth strategies.
Right.
That almost goes back to your example of working that business leader of like, okay, let me understand your organic growth.
Right.
And we can look, let me understand your organic growth thinking and not share ours.
Yeah.
And we can start seeing if there's some common threads to pull.
Right. I think that works typically, right? Because then you see where the gaps are and where one can help the other. Yeah.
Do you convince people to sell their business?
No, generally no, right? So I think so. It's a process, right? So I tend to think that it's hard to convince people to go through that process. I think what we end up doing, right, is offering them a path, a solution to the problem or the strategy that they're after, right? And I think they kind of like then convince themselves, right, as to whether they take that solution or no, right? The classical example will be we're talking to an investment manager, right? There is an older owner, right, an older person that was the founder, and then they want to exit the business, want to sell, right? And so we come in many ways as a solution provider, right? Like our solution is, look, we will buy the firm for you so you can exit the business. In my experience, unless they're ready to exit the business, there's no convincing. Yeah.
So you take more of a patient approach,
right,
where you focused on building this relationship, and then you want to be the first phone call when they're ready to sell. Right,
exactly. Because I think my experience tells me, right, that for a seller to sell, they need to be ready to sell, and so there's no argument that I can make to a person or to a founder that is not ready to let their firm that they found go, right? They need to be ready, and I think it's at that point, right, that I think we can be useful in the solution. But yes, I mean, I think that could happen over a period of a year, it could happen over a period of 6 years. And I think building those relationships so that, as you put it, right, you are there, right, and they know you, it's critical.
I don't have patience.
You don't have patience?
Maybe this is why people are asking for such high valuations every time I look at a deal.
Right.
They're like, oh, well, if you really want to buy.
Right, then overpay, right? No,
give us 10x plus, then we'll sell to you. So maybe that's, I got to learn some patience.
That's the one to convince, right? Like over and sell you, maybe overpaying, and then you'll get them over the hump. No, but I hear you. I mean, patience is tough, right? It's.
You're telling telling the devil here. Everybody in my family will agree with that.
Yeah.
That's one thing I'm lacking, but it makes sense. You want to, at least you're taking that. What are you doing to maintain those relationships? 'Cause I feel like that's the other thing I've struggled with, where you meet a founder. I had this actually happen. And it was almost, I thought to my head, like, let me check back in with this 6 months. Totally forgot about it. And at the end of the year, he ended up selling to another competitor. And I was like, but I didn't have any clue that he was ready to sell or anything.
Right. It's tough, right? Because as you it requires quite a bit of time, right? And discipline. Look, I think you cannot, at the end of the day, you cannot cover everything, right? You have to kind of like narrow your focus right onto certain areas where you have interest, and then you cultivate relationships in that particular space, and you have to go narrow, right? You have to go. You can't be cultivating relationships with 100 firms, right? At any given point, I think anywhere from 10 to 20, that's probably the max that you're going to do it effectively, and so you just need to focus, right, on what is the most important from kind of like the deliverables and the results that you're trying to achieve. And then the way you do it is just kind of making sure that you remember to call them, right? And we work a lot overseas, right? So every time that you go around, right, traveling, then you make sure that you meet with them.
So just try to meet people, FaceTime.
Right. And then narrow your focus, right? I think that's That's critical. You can't be kind of like cultivating a relationship in 4 different sectors and in 4 different industries. You just can't. Then you won't do anything. I think you just have to really narrow into the areas where you are most active. And then at any point in time, which we do, right, have a pipeline of 10 to 15 companies that you are actively cultivating the relationship. Yeah.
Where do you find the companies? Are you just going through data sets, or do your business people already have the relationship? I've found private equity recently to be helpful in building pipeline.
Because they want to sell.
Not because they want to sell. It's just you build a relationship and they're like, we passed up on this deal.
Right. So deal flow sharing. Yeah, for sure. Yeah. So three primary channels, right? So the first one is intermediaries, and I think of private equity. Well, there's no private equity there. Intermediaries, investment bankers, Big Four, right? They're obviously connected, right? And obviously, if you're an investment banker, it's your job, right, to sell companies, right? So one that's one element of deal flow. The second one is other market participants, so private equity firms. That either they want to sell or they passed on something. Other peers, right? Other financial services firms. And then finally, the third, right, is essentially data sets, right? Which I find the most fun of it all, to be honest, where you kind of like filter the industry. You narrow kind of your criteria. You go through a data set. You filter it to 10 or so, and then you start calling them.
What's your favorite for your industry for data set?
Like the one that I use. So we use Capital IQ, and then we also use, I forgot the name right now. But Capital IQ will be one of the best ones that we use in terms of accessing data.
Yeah. And are you using that? Because obviously they have really good coverage on public, but you find it good for private too?
Yeah. Okay. They do. There's another one, which I just remember, Preqin. That has pretty good access for private.
Preqin set it off, man. BlackRock acquired them, and now everybody's on a buy private company data frenzy right now.
Right. No, BlackRock. I mean, they are with Aladdin, right? Aladdin, and then this one. They, in terms of private asset managers, right? They've got a really good penetration. Yeah.
Okay. So you go through this. Got these different sources. We find these deals. We build relationships. You look for that opportunity when it's like, hey, the company's ready to sell, or you're fortunate enough to reach them at the right time. So you described yourself even before as a valuation geek. How do you think about intrinsic value versus relative comps when evaluating deals?
Right. Yeah. So I think, look, every practitioner has a different approach to valuing an asset, right? And obviously, we all know the 3 methodologies, right? Discounted cash flow, intrinsic, and then relative value. You will look at present transactions or publicly traded comps, right?
Should we explain these real quick? Because there's people brand new to this. So
of course. So then DCF analysis, right, is when you forecast the financials of the firm, right, and then you discount them back using a discount rate, right, which essentially is supposed to reflect the riskiness of the cash flows, right? So essentially you're discounted it. The cash flow, you discounted it back to today using that risk metric. And then that gives you what in the trade, right, we call it intrinsic value, right, in the sense that is, in our view, right, what is the intrinsic value of that asset, right? And that's the DC, discounted cash flow analysis. Then there is the comps, right, which are not forecasting, right, the financials of the firm, but rather you're saying the firm, it has a certain amount of earnings, EBITDA, and then you look at what others have paid as a multiple, right, relative, and then you say, well, if others have paid X times earnings, and there is a comparable publicly traded firm that is trading at X times their earnings, then it's reasonable to assume that then the firm that you're valuing, right, should have the same value, right? So you use the multiple, the 10 times, right, and then apply to the company's to the target's EBITDA or earnings, and that essentially is what we mean by relative, right? It's relative to what the market is paying for them and what others have paid for similar firms, right?
Yep. And then you make your nice EBITDA adjustment table, and
right, and you pay less. Right?
You try to.
Or you try to, yeah. So these different schools of thought, right? So some people like relative valuation, right? Because it's easier. There's less assumptions. It's more market driven, and it's easier to explain too, right? And so you might think that my view, right, is private equity tend to use, right, relative value just because they like to use that approach. And then the other approach, right, is you put more weight into the DCF analysis, right, where it's more complicated, more assumptions, more thinking that has to go through it, much more difficult to explain. But in my and that's kind of like the other methodology.
This is where you really incorporate your synergy assumptions on the deal.
Right, exactly. So I think the pros, right, or the advantages of using a DCF, right, is you can get granular on things like that, right? You can get granular on the synergies, for example, right? You can phase them in or out, right? You can phase them over time, something that you couldn't do on the comps, right?
Right.
So the DCF analysis, right, allows you to become much more granular about certain things, and more precise. You can calibrate the discount rate, right, that you use. You can separate cash flows and use different discount rates, right? So essentially, it's a much more precise way of calculating the value of a firm, whereas relative value is a much simpler but less precise, right? And you can't really calibrate, right, or dial up or down certain specifics, right? But look, it's just pros and cons, right? Everyone uses, some people, which is the approach that I like to use, right? They use a primary methodology, which I tend to like DCF. And then you use the comps, the relative value, right, more as a guide, right? Are you off, kind of like what the market is telling you? Are you very low? Are you very high? But you use the DCF as your primary methodology.
Primary, and then the secondary could be the just
The
looking at comps. Yeah,
right. Like
that
I don't
makes
want
sense.
and I think, and obviously for practitioners like I am, right, that I think we take pride on our analysis, right? I mean, these rigors, we want to make sure, of course, that we never pay more than what the intrinsic value is. And the only way we can get to that intrinsic value is through the DCF analysis.
Are you pretty transparent with the model when you're talking to a target?
Never.
Never.
No, right, never. So that's mistake, which I've seen many times before, number one, which is hoping that then the seller, right, will agree with you on the assumptions that you're putting for the business. It will never happen.
They'll just tinker with your model.
You'll never agree, right? Because then you end up fighting over and over and over about assumptions on the modeling. Then you'll never agree, right?
Interesting. Okay, this is good. I need to learn this stuff.
So but again, everyone has.
Because sometimes people come, they do the comp thing, like here, headliner deal, and it's like, okay, that company is like growing like 80% a year. You're not growing at all. You're flatline business. You're not going to get that valuation at all. And so there's that piece. And then part of me is like, oh, well, let me just show them how I came up with the math. And just, kind of trying to think I'm building a relationship by being transparent.
Right.
But you're telling me not to do that.
I tell you not to do that, right? Particularly in the DCF analysis, right? Because in my experience, it's like the death by 1,000 cuts.
Yeah.
So they'll try to negotiate you on whether the equity risk premium that you use for the discount rate is the right source or should be another source, right? So you'll never, in my view, right, you'll never get there. So my typical approach is where I'll just, we just tell them, this is how much we think your business is worth. If you want more, then counter.
Can you walk us through how you model discounted cash flows, especially in these cross-border situations where assumptions like discounted rate and currency risk come into play?
Yeah, so I think when you think about cross-border, right, the two risks, right, that you're trying to quantify and measure, right, is the currency exchange rate, because obviously the expenses and revenue of the target, right, are denominated into different currency. And two, the geopolitical risk, right, associated with a business doing business, right, the target doing business in another jurisdiction, right? And so essentially there's two schools of thought, right, to measure those two risks, right? The one school of thought is where you forecast the cash flows in their local currency, and then you use a discount that is local. So for the discount rate, you use the comparables that are companies traded in that jurisdiction, equity risk premium from that jurisdiction, etc. And then you discount those cash flows at the local currency, and then that gives you a value in the local currency. And then if you want to translate that into your into your reporting currency. So we're in the US dollars. Then you just exchange it at the spot rate. The idea there, right, is that all the country risk, all the currency risk is being measured by the essentially the discount rate, the local discount rate that you're using. And then you're forecasting local currency, right? So you're essentially controlling for that because you're forecasting local currency.
It's all based on, so just localize the whole model in the currency, then it's just all
the discount rate.
Yeah, just adjusted right into it.
I don't like that method.
No?
No. The second one, which is the one that I think is a more rigorous and I like better, right, is where you continue to forecast in the local currency. Because I think that's better, and we can talk about why that is. But then, for purposes of discounting and the DCF, you first translate those local cash flows in local currency into your reporting currency using a forward curve. Now, the forward curve, right? So this is the forward curve. I will tell you essentially that's a measure. It's trying to measure the inflation rate, right? So an exchange rate going forward, right? So you're exchanging local currency into euros at a future exchange rate. And then that's supposed to capture all the currency risk. Then you have your reporting currency cash flows. And then for the discount rate, you use your own country or your own reporting discount rate. So using, for example, the US companies. But then what you do, right, is you add a premium to the discount rate, which is a country premium, which is supposed to measure the additional risk with the cash flows that now are coming from a different jurisdiction. I like that better overall, right, because you're then able to, again, you have more precision. You're able to kind of dial up or dial down the country risk the way you feel, right, depending on the geopolitical risk of that country. And I think it's more transparent overall.
That's interesting. So you'll actually forecast the currency.
Yeah. So we use our sources, right? I don't think that I can forecast exchange rates, but you can get the forward curve, right? You can get from bankers, you'll get their consensus on the expectations of currency.
That's interesting. I mean, we look at the euro, and we've seen like pretty significant changes just in the past year.
Yeah, no, that's right.
Changes that are favorable to us, now they're not as favorable to us.
No,
so.
that's right. That's right. Yeah.
And then the same likewise with adjusting the cash flow would be your other of overall risk of doing business in this country.
But the important thing at the end of the day, right, is not to do particularly cross-border, is to somehow measure currency risk and geopolitical risk.
Yeah, geopolitical.
And there are two ways of doing it. They're both valid, right? So there's nothing wrong with any one of them, right? It's just that the second one, I think it is more intuitive and
it's more direct of just, like, hey, this is where we think things are, literally both in currency and the geopolitical side.
Right. I think the other advantage, which is going through this in another thing, right? The other advantage of using that second method where you're forecasting the local currency, but then you translate into euros using the forward curve, it is that if it changes to the forward curve, to your example, right, of changes in expectations of the currency exchange, then you can adjust it live, right? And then that will have an impact, right? Whereas in the first method, right, then you can't. Yeah.
Makes sense. These are good stuff.
Yeah.
Other things, deal structuring. What are the most overlooked aspects when it comes to deal structuring?
Yeah, look, I think deal structuring in many ways has to do with protecting, in my mind at least, right, protecting the downside, right? So in my mind, right, you've gone through the evaluation exercise, you've come to a price that you think, okay, this is fair. But how about if the firm doesn't perform going forward, right? Like it's not what you expected from a financial perspective, right? So I think deal structuring, in my mind, has a lot to do with putting in place tools within the structure that in the event that the company underperforms financially, then you are able to reduce the amount of money that you pay, essentially. Or you are able to then get priority returns, right? So get more money ahead of the other shareholders of the company. That'll be another way to structure, get priority, right? But I think that at the end of the day, right, that's really what what matters, right? Because at the end of the day, right, if the company performs as expected, right, if you kind of forecast the firm and the company performs just fine, then you're going to be happy, right? No one is going to complain. The issue, right, is when it totally underperforms, right? And so having things such as earnout in place, priority returns, guarantee returns, so minimum returns, will allow you to continue to perform, right, at the returns that you expected, even if the company underperforms.
Protecting your ass.
Yeah.
So you have
Exactly.
well, you have a few. Okay, like warranties. I know.
That. Yeah. Yes, I mean, I think that's another set of structuring that you can do, right? So if you think about sort of risk management on a transaction, right?
Yeah, so we just you got warranties,
Right.
Then you got a whole reps and warranty policy. There's like
Right.
other things, but you have reps, your warranties, your earnout,
Right.
and then you mentioned priority returns.
Yeah.
Can how does priority return? Well, let's start with that one. How does priority returns work in M&A?
Yeah. So you say what happens, right? Is you say, well, we're going to structure a deal in that you and say typically the way it will work better, right, is like if we are 80% shareholders, so we buy 80% of the firm and 20% remains with someone else, right? So we buy 80-20. That's the easier way to explain it. And then in that context, right, you're going to get 80% of the earnings, the other person is going to get 20% of the earnings. But then we structure a deal where we say, look, over the first 5 years or over the first couple of years, I'm going to get 100% of the earnings, and you're going to get nothing, right? And so that's priority, right? So I'll get the first priority on the money and the earnings, either for a period of time or until certain performance is achieved, and then you, the other shareholder, you don't get nothing until certain things happen. That's the way priority returns are, right? So if it performs the way you think, then I get 80, the other person get 20. If it underperforms, I'm going to get my first.
Yep.
So I'm going to get my 80, and the other person is not going to get. You're going to get nothing, right?
Right.
But even in underperformance, I continue to get my 80%, right? And so there's many ways of course structuring, right? But that's essentially how it works, right? So you will get the first priority of the earnings ahead of anyone else. And of course, again, if it doesn't perform as well, then that would obviously to an extent, right? There'll be if it totally underperforms, then you are going to be worse than you expected, right? But that protects you somehow.
That's interesting. That kind of reminds me like the VC, like getting your preference, you know.
Right. So that's right. So VC works like that, right? I think it's the same concept apply more to a cash flowing companies. The VC guys, what they do, right, is like they'll get, so when the company sells, right, they will get their preferred return, whatever that is, right? And then after that, right, the proceeds go to the remaining shareholders. That's what sometimes the common equity get wiped out, unfortunately, right? It's the same concept, really.
Yeah,
but it's just more applied
the
to
cash
earnings,
flow.
right?
Yeah,
It's more applied to cash flow, kind of like year over year cash flow. Yeah.
So we got that covered.
Yeah.
What was the other tools we got? We had earnouts. I think a lot of people are familiar with earnouts.
Right. So essentially, like,
you love them, hate them? What's your?
So look, I think there's goods and bads, right? So I mean, I think so. Most practitioners are cautious about them, right? Because there's litigation risk associated with that. There is issues with obviously restricting the operations of the firm, right? Whenever you are buying a company and you put in place an earnout, chances are that the seller of that company, right, will put some restrictions for you, right? You can't do anything as a buyer that you want because that might impair their ability to make the earnout, right? So those are the negatives, right, of the earnout, right? The positive, of course, right, is structured right. Then you end up paying less if the company underperforms, right? So I like them, right? But I think you have to be careful, right? I think there's some people out there, like they think the earnouts is the solution to it all, which is not.
It's easy to be the solution to it all.
Right,
it's so
right.
easy.
And it sounds great, right? I mean, of course, why wouldn't I?
Pay less money up front. Pay another picture. You don't hit your numbers, fine.
Right.
No worries.
I think you need to be cautious, right, of the knock-on consequences, right? Like the strings attached that come with the these contingent type of structures. And then there is litigation, right? So there's quite a bit of the litigation will come here in place where the sellers, right, don't make their earnout, and then they sue the company because they say, oh, you didn't let me, you did X, Y, and Z, and you didn't.
How does those usually turn out? Like if I'm looking at a deal right now and I'm like, okay, they want a big headliner deal price. And
Right.
I get that. So we'll structure it. And you're like, okay,
Yeah.
you kind of know that this is going to be hard to do. And it's but given that, now I'm probably going to anticipate some litigation because they're not going to be happy. Like what ends up happening?
Yeah, no. So I think it all comes down to clear drafting, and I know it kind of like is a generic answer, but it is true, right? So I think the way you draft the earnout, right, and the contracts has to be very simple and clear, and not ambiguous. I think the room for litigation in many ways it will come when something was not drafted precise enough. So there's room for interpretation,
Okay.
and I think there is the room, right? I think if you draft it clearly, if it is simple, then they might litigate, right? But they just will have no grounds, right? Yeah.
So these are good points. Okay, we got priority returns, earnouts, warranties.
Yeah. So we talked about sort of if you think about like priority returns, earnouts, it's more about financial and net performance, right? But the other risk, right, that you need to manage as an M&A, right, is how about if what you get is not what you think you got, right? How about if this firm that you just purchased, in fact, has a massive liability, right? A lawsuit that wasn't disclosed to you and that it wasn't public somehow, right? So you couldn't even find out through diligence, right? So, because these companies primarily have been, many of these companies that we work with, right, have been operating for many years. There's no due diligence in the world that will allow you to be 100% certain, right? You're always inheriting an unknown risk. And so warranties and indemnities is a way to shift the risk of unknowns onto the seller. And that is one thing that it is, to your question at first, right, as to what are one of the things that people don't care much about. That is one, right? People don't tend to think that, negotiating a very robust rep and warranty package on your contract from a buyer perspective is critical. They just don't care too much about it. Mm-hmm. And you know why? Because they've never had a deal that went wrong. If you talk to practitioners that have been around for a while and some deals that they've had have gone wrong, they totally understand how important it is. Because what happens, right, is if the deal is going no problem, right, and it's going well, your contract, right, is on the drawer and no one cares about the contract. The moment that things start to go south, I can assure you that then the contract is going to be essentially the most important thing in the world, right? And when you've gone through those processes where, what is important is what is in the contract, is that then determines what you can recover, you can, then you realize how important it is. But most people don't think about it, right? Because they say, well, who cares? What is this contract I'm doing? I'm here with rest and warranties. I don't even quite know what is this for. It is critical, right? Because if the deal goes south, right, that is the one area, right, that you're going to use to be able to recover. So that's the one thing that I think.
Can you give me examples of these warrants?
Yeah. So you remember the Madoff disaster, of course.
Yeah.
When we are back then, right, when you were buying investment managers, we want to make sure that we weren't buying an investment manager that had Madoff exposure. But of course, you go back because there's these there were a lot of investment managers, right, that were involved into that, right? And so you would want the company to warrant to you that they didn't have any exposure to Madoff, right? And then, right, because then you close the transaction on that basis, right? And then if you later find out that in fact they had it because there was something that you weren't aware of, right, and it was there, then you can go and recover, right, and sue the firm, right, and get some compensation, right? So that would be a good example, right? Another typical warranty will be, or representation will be you don't have any lawsuits, and that would be another one, right? So to the extent that you close, and then all of a sudden you realize, you find that there was this lawsuit that the company didn't disclose to you, and that you didn't find through diligence, then you have the ability to then go and sue the company and recover, right, some compensation. So it's essentially you're asking the company to tell you that certain things that are bad are not there. Because in fact, if there is, right, post-closing, that you have the grounds to be able to recover. Otherwise, you got nothing. Or as a buyer, right, then you're stuck with a liability that you didn't know about. have no ways to recover.
What's the difference between warranty and reps?
So a rep and warranty insurance, or
it says how do you use reps, warranties, and earnouts to protect value.
that's it, right? So
reps. So there's not just separate reps.
it's kind of like the same, right? So it's a statement of fact, right? Either the rep or the warranties, they're used interchangeably. So you can use them both the same way.
Okay, so when you say warranties, you interchange the word as reps, and then when you hear of reps and warranty policy, they cover both, right? They cover both terminology, just general, like, hey, I guess we can walk a little bit through about how do you use those policies.
Right. So essentially, and it's relatively new financial innovation, right, with reps and warranty insurance, right? It's been around for a while, but only for a few years, right? So, without warranty insurance, rep and warranty insurance, right? If a warranty is breached, then you go and sue the company that you bought, right, or the shareholders of the company. Now, if you buy insurance, right, then it is the insurance company that will be providing you with compensation, rather than the shareholder. Or the firm that you just, the shareholders of the firm that you just bought. So essentially, it's a shifting, right? Just shifting the risk from the seller to the insurance company.
It's it's interesting because before you always do a holdback, right?
So you could do it, right. So
or traditionally
you could.
Mostly you do a holdback, and I feel like its alternative is reps and warranty, which you pay.
Right.
Who usually pays, seller or buyer?
So in this case, you're buying, right? So then the seller has breached the warranty. So then the seller is paying you, the buyer, for the breach.
Who pays for the policy at close?
Oh, right. The policy is that, right? So then typically it'll be the buyer, right? So the buyer will pay.
Buyer pays for the policy.
Right.
They get that coverage. They don't have to do a holdback. Seller is happier about that.
Super happy, right?
Something does happen, though. That reps and warranty policy usually just goes up to amount you typically have a holdback on.
Right, so it depends, right? So it could be, right, so I think you negotiate with the insurance company, right? So it could be the whole amount of the purchase price, it could be something less. For example, it could be situations where the insurance company does not cover a particular warranty or rep, right? Because they don't want to cover it.
Well, you got their exclusions that they'll put in there.
Exclusions.
So they'll do their own diligence and say, all right, we're not going to exclude all this stuff.
Warranty. In which case, then you go back to then having to put some of the proceeds in escrow, right, so that it covers it in case of a breach, and then the responsibility shifts back to the sellers, right, because the insurance didn't cover it. But I think it's important to understand, right, that the creation of this business, right, which is rep and warranty insurance, has totally transformed the business. The seller is happy, right, because they're not on the hook, right, for most of the warranties. The buyer is happy, right, because the insurance companies are much better paying than the sellers. So everyone wins, right, in that situation. And I think you can check. There's a lot of literature out there that is monitoring, right, how often the insurance companies pay, and so far they've always paid for the most part. So there's a track record of insurance companies paying when they need to pay. And in most cases, to be honest, right, people are honest, right? So then there won't be a necessity to. The reps and warranty will be true. So I think it's good for everyone.
Yeah, it's interesting. I'm hoping I got some data on this stuff of policies that get paid out. It's really interesting hearing the stories. So I'm hoping we can publish that.
Yeah,
that's a good reason to follow me on LinkedIn. I always post silly stuff like that. The question I have was around alignment, right? You have valuation. We talked through the deal structuring and how that's important. When you look at correlating between valuation, diligence, and integration planning as the deal progresses, how do you think through that?
Yeah. So it's I think of a kind of like continuous circle, right? Yep. So first in the way I typically do it, right? First you come to a value of the firm that is on a standalone basis. Mm-hmm. So you don't think about synergies for now, right? And then you add on either expense, revenue, both synergies, right? That increases what you think the company is worth. Right, and then you typically kind of come to make some number of assumptions. You come to a value, right? Then in the diligence process, it's all about retesting those assumptions, right? So, for example, right, if you think next year the company is going to win 5 clients, then you're going to check in the diligence process, right? That then in the past they've won 5 clients every year, for example. Right? So then you feel much more secure about that assumption, right? So the diligence is, in my mind, right, is a process of continue to test your operating assumptions that then drive then the DCF, right? Then in diligence as well, right, is a way to then, because obviously you're starting to think about refining your synergy assumptions, right? So how much cost, if any, you're taking out, or revenues you're going to increase. And then you, in the diligence, you continue to then retest and refine those assumptions, right? So it's kind of like a vicious circle, right? So
yeah, so you'll find stuff out in diligence that's like, wait a minute, we got to adjust that assumption on the synergy based off what we found in diligence.
Exactly.
You know, there's certain things that we not going to hit as much revenue synergies like we thought we are because totally different sales market, or we don't have as much overlap in customer base like we thought we did,
for example,
right? And then so we'll adjust that. Okay, that makes sense on diligence feeding back to the model. And
integration,
then
right?
Integration planning.
Yeah. Right.
Nobody wants to talk about integration these days.
Who wants to talk about integration? No, right. Yeah, look, so I think integration has, in many ways, integration will have, and that's what I mean by not a vicious circle, but a circle, sorry. Integration has a big component on the synergies, right? So for example, right, you will need to think about how you integrate. So you have two teams that are overlapping. So you will need to understand how those two teams will integrate to see how much cost you can take out, right? So in diligence, we'll start digging into how you're going to integrate the two businesses. And then that will then not only inform your plan as to how you're going to execute on that integration, but then will confirm your integration assumptions, right? For example, on the revenue side, right, you're planning to integrate two sales teams together. And then you have to come to a view as to whether that combined team is going to sell more or less than your standalone, right? And so that the integration will inform your synergies. So essentially, it's a circle that continues goes on, right? The more you learn about integration, the more you can refine synergies, and then you can adjust your evaluation. Right? The more you learn about the company, the more you can test your assumptions, operating assumptions, and etc. I think the key is in this, right, is, and I see some practitioners not doing it, right, is making sure that you know that what you're paying for the standalone, and then what are you paying, if any, for your synergies, right? I think I've seen some practitioners out there where they have one kind of synergistic view of value, and then they say, oh, I pay X for that, right? And that's not the right way, in my mind, right, the right way to do it. You need to come to a view of value on a standalone basis. This is what, if this company, hypothetical buyer, right, there's no synergies, there's no integration, what will the company be worth? And then you then layer on synergies, and then you decide, right, whether you want to in fact pay for those synergies or not in your purchase price, right? But differentiating between the two is critical, and it adds lots of discipline. Yeah.
That's no, this is the right way to really think about it. Yeah. Is it does all feed back into each other. And just
right, yeah.
Good.
No, I think one of the pitfalls that I see, right, of course, it doesn't happen in my shop, right, but I see it in other firms, right, where it is hard to change things, right, and we'll talk about inertia a little bit later, right, but it is hard for deal teams, right, as you go into diligence and you find something, right, that is really telling you that the assumption that you had pre-diligence when you submitted the non-binding LOI, right, is just not right? It's just hard, right, for the teams to kind of coalesce and say, okay, we're going to change this assumption. That may mean that we might have to go back to the seller and say we have to pay less. I think having that discipline and being able to in fact do it, right, when you feel like you need to, it's very important.
It is. I agree. I first learned about this from Carlos Sesta. He, because not a lot of people actually, I think you're a tried and true corp dev person when you really think about it this way. Because when they teach M&A, they teach you the phases like in a linear line. But actually it should be like more of a 3D thing with like a spiral framework is what we call it. Because it's like a spiral. I'm actually working on a course to teach like that many life cycle, but I'm adding that in there. It's like, okay, this is a life cycle, but understand it's not, it actually goes like this.
No, it's very circular, right? I think that's the key, right, to one of the, in my mind, one of the successes in M&A. And it's not just M&A, right? It's buying an asset, right? However you want to buy, right? It is that as you learn, because if you think about it, right, it's very imperfect information, right? Or imperfect situation. The sellers, particularly in a private asset, right? If it's publicly traded, then it's different, right? Because but in a private situation, you as a buyer will never know enough or as much as the sellers. The sellers will always know more than you do, right? And so the critical thing here, right, is digging as deep as you can. And as you have more information, then always filter that information into your operating assumptions, right, that drive value and other things. And if you do that, right, and you do that dynamically, or you're constantly doing it, then I think you'll end up with a very good, precise price, right, for that particular asset.
But like once you get to LOI, right, everybody always rushes to get to LOI. And then afterwards, I mean, you still should be doing this, adjusting your model afterwards, right? It's definitely a lot harder to if you want to go back and renegotiate, that's always a tough thing to do, or things that some people like religiously will avoid it. They won't do it. They just either,
Right. So I think there are two schools of processes here, if you will, right? There are people that kind of like to get fast into LOI, like very high level assumptions. Not really. I mean, there's some analysis, but not that much, right? And then they go deep in diligence, right? But of course, then there you have to be willing to then kind of like change things, right? Because you learn more, right? The other school of thought, right, is that you're going to put a lot of work, right, into the LOI itself. Sometimes you can't do it, right? Because it's a competitive process and you have to do what you have to do, right? But if you are able to, right, then you have the choice, then people want to put a lot of work on the front end. So they have a very well-baked price that they feel very comfortable with in the LOI, such that then the diligence is more confirmatory. It's making sure there's nothing like totally wrong with the company, right, or weird, or illegal, right?
Right.
I think you can calibrate in between the two, right? Approaches. Yeah. I like if I can, right, because the process allows me, right? I like putting a lot of work on the front end, rather than putting a value there that I'm not so sure about, right, and then having to retrade or having to renegotiate in diligence, right? Because that doesn't help anyone.
And you got to stay out of auctions to do that.
Right. I mean, sometimes you can't. You need to do what you need to do, right?
That's true. I found too the nature of the deal. Sometimes it's very like direct competition. There's that makes it really tough.
Right.
And then it's just a lot of factors with the people. Some people are just finicky like that. They just want to see where you're at with price, and they want to want to do that with this little information. But then, that's. So I agree. I think generally, if you could do more up front and really, at least the key things, right? Your real big assumptions you're betting on. If you can sort of do that up front, maybe it's requiring a few technical folks to talk to each other and things like that. But
I think so. That's what I think. Like bilateral situations, right, tend to be in many ways more efficient, right? Because then you can get to an LOI that you feel comfortable with, and then right, if the price is not there, then you stop there, or you don't do anymore, and then you part ways. Whereas in more competitive auction processes, right, then you might end up with two bidders, right, that they just put a price, right, on non-binding just to get into the next phase, and then the next phase they find what they find and they don't like it and they walk away, right? So in many ways, I think bilateral situations, right, tend to be more efficient, but again, I'm sure my sell side banker friends will disagree with me, right?
Well, let's settle that at the bar. Any bankers listening to this, we love you. Like there's points. I'll tell you, I got one of my classic guys, Nick Schumacher over here. I can't get him on the podcast. He's a little microphone shy, but I just learned so much about negotiating deals and structures from him, because it's he's just done it. And it's just, there's things like I would want to pull him on a deal in a situation where it's like, I can tell he's done this. He'll know how to really negotiate it well when it's really intricate. But
I bet.
But we don't like the auction process. Find something new.
Conclusion of the podcast.
Let's interview. Can you share a negotiation story, maybe where there's a moment where theory clashed with reality and what you learned from it? This is one, I don't know if marketing pulled this from AI, but
no. There's so many, right? So there was one. Oh, right. So and it comes to mind right now because we're talking about changing the price in the diligence, right? So there was one situation, right, where we were in diligence, right? We had negotiated the price, right, and non-binding LOI, but then we had in the non-binding LOI for the valuation, right, we had assumed that a couple of big clients will come in. And so in diligence, we learned that in fact, most likely than not, those two clients are not going to come in, right? And we learned that because we were able to see some data, right, that suggested that they were not going to come in. And so, of course, we learned that in diligence is significant, it's going to reduce the value. So kind of like the rational, if you kind of like follow the or subscriber of the school of thought in negotiations that the parties are rational and that you find a commonality, etc., right? Then, which is I was early in my career, right? So that's what I thought. Then I thought, well, of course, right? If I go back in front of the seller, I'm going to tell the seller, look, those two clients are not going to come in, so you totally understand that I need to lower the price. So that's what I did. I went back into the boardroom. I sat down with, imagine kind of like 6-7 people on the sell side, right, and the sellers were on our side, and explained, look, you would just learn, as you know, that these couple of clients are not likely, so therefore we need to lower the price to X. And then the reaction was like a cell phone being thrown at me, and then got up, the entire...
Wait, did you literally have a cell phone thrown at you?
Yeah, literally, right? And the entire team, right, left. Obviously, the CEO kind of got up and left. Well, first throw the phone, got up and left, and of course, everyone else followed him. And then got out of the room. The guy picked up his phone behind me, right, and left the room, right? And so, and then I learned a real valuable lesson there, right, which I can explain later, right? But that is, to your example, right? That's people are rational, right? You think that people are gonna, understand a very clear example, right, where it wasn't a factual conversation. He knew that those two clients were unlikely to come, and he knew that we're likely, right, when we purchased this, because he told us. But it's in many ways, right, which is what I subscribe to, and if we talk about negotiations, we can expand on that. I think in negotiations, you are talking with irrational beasts. People are very rational animals. Man,
you subtract 20 foot off anybody's yacht they're planning to buy. That's right. Enough to throw a cell phone at you.
Exactly. That's going to happen, right? So there's no rational behavior, right, that sometimes just rationality goes right out the window, right? Because again, the argument was very rational. Like, he should have understood it. It was a big drop, right? But at the same time, but he didn't.
So I was going to ask you, what's the craziest thing you've seen in M&A? You had anything crazier than getting a cell phone thrown at you?
No, I mean, I think those are kind of the experiences that are, that I think negotiation tables, right, tend to be quite crazy, right? So I think that's where you get most of the crazy stuff, right? Because I've got people telling me like, oh, your offer is cheap and you are cheap, right? So kind of like attacking you, right, in the negotiation tables, right? Wow. But look, I think it's primarily there, right? I think in the negotiation tables when I think the egos come into place, and sometimes it's not black and white, right? It's a lot of gray. That I think crazy things like phones being thrown at you, right, and people telling you are cheap, right, and things like that do happen, right? And I think, look, I think my advice to everyone, right, is to always kind of like be calm, right?
Yeah.
I try to dodge.
Yeah.
To dodge, sorry, the phone.
Yeah, dodge.
But try to kind of like stay calm, right? And understand that at the end of the day, right, you're not in these negotiation processes, right, and you're not working with, including yourself, right? And rationality most times just goes out the window. There are other things that you can do to ensure that the process is well run, but sometimes it's not about kind of finding common ground, because you won't find it. Yeah.
That's so great. Yeah. I appreciate taking time for this conversation. You've helped me become a better M&A scientist.
No, of course, love to. Yeah.
Fellow listeners, love to get feedback, hear from you, especially if you've gone all the way this far. Like, I want to eventually give some reward for how many podcasts you listen all the way to the end. But reach out to me. I like connecting with listeners on LinkedIn. Love hearing your ideas on how to make this podcast better, topics I haven't covered. And I take the criticism. I like you taking that so I can get better at this. Till next time, here's to the deal.